Hello, everyone. My name is Richard Leggett, and I'm the CEO of FrontierView. On behalf of my colleagues, we welcome you and thank you for joining this episode of GlobalView. This month, my colleague Elizabeth Rust, who's our senior analyst for global economics, and I will talk for a few minutes about some of the major global macro level issues that our multinational clients are grappling with. It's now been 6 weeks since Russia's invasion of Ukraine, and we're already witnessing a variety of effects on the global economy. And when you couple that with concerns about the outlook for China's growth this year and tightening financial conditions, it seems there's no shortage of uncertainties that our clients are grappling with. Many of our clients are also just starting to head into their planning cycles for next year and are having to completely reassess their assumptions, their plans, and targets that were set just a few months ago. So on that note, Elizabeth, welcome. It's perfect timing to be here. What are the top issues that we've been talking about with clients in the last 3 months?
Great, thanks, Rich, for that introduction. And yeah, let's jump right into it. Here are 3 things that are kind of floating to the top of the agenda in a lot of our recent client discussions, especially ever since Russia's invasion of Ukraine. The first is the issue of high global inflation, which is increasingly a theme across the entire global portfolio. It's already been an issue our clients have been facing for several months, the issue of soaring input costs and what to do about their pricing strategy in this environment. But increasingly, we're talking with clients about the risk of demand destruction, and we'll talk about what that means. The second is the impacts on global manufacturing, kind of the early impacts we're seeing stemming from the war and spillovers from the war. And we're just getting some early data that speak to that. So we'll talk about what we're seeing so far. The last is the issue of China's lockdowns. We talked about that briefly last month in last episode of GlobalView, and there's been more developments there. And that's clearly, it's shaping up to be a factor almost as impactful as the war in Ukraine, actually. So we'll talk a little bit about that too.
Okay, great. These are 3 huge topics, so I want to dive right in. And I'm actually glad we're starting with inflation. It's quite timely because in the US, we had data out yesterday that showed consumer price inflation had accelerated to 8.5% year on year in March. And that was the highest since 1981. This is an environment, Elizabeth, we haven't seen in over 40 years. And I can only imagine that the war in Ukraine will exacerbate the supply chain challenges that have already contributed to this high inflation and potentially drive inflation even higher. So I'm curious what trends you're seeing in inflation across the global portfolio.
Yeah, you're right about that inflation figure coming out of the US, highest in over 40 years. This is increasingly, again, a story across the entire global portfolio. It's not limited to the United States. The issue of high inflation kind of begins on the producer price inflation side. So these are the prices, the input costs experienced by businesses as well as their selling prices. And it's been the case for several months now that we've seen rising producer price inflation across a huge variety of markets around the world. Probably on average across major markets, around 10% annual producer price inflation. But there's some variation there, with some markets like the Euro area now above 30% year-on-year producer price inflation. And a lot of that stems from this energy supply disruption stemming from the war and even preceding the war to some extent. So soaring producer price inflation, soaring input costs for businesses around the world. And that's one big factor that's contributed to higher and higher consumer price inflation. One, due to pass-through, as businesses pass on their rising input costs to their customers and to the end users and consumers. Another stems from a lot of these production disruptions that we've seen with disrupted global supply chains, creating shortages of consumer goods, and that's contributing to price pressures as well. Until very recently, so kind of on the eve of Russia's invasion of Ukraine, you saw some interesting patterns with inflation around the world. It tended to be highest across the Americas, all of the Americas, North America down to Argentina, and in Europe, and again, across Europe as well, with some spots of high inflation in sub-Saharan Africa and the Middle East and North Africa, depending on the market. But Asia Pacific was generally dodging this trend. You were seeing stubbornly controlled inflation in these markets, even despite really high producer price pressures. We're estimating that this is increasingly going to change. that producer price inflation is headed higher in a number of markets, including in Asia, and that it's only a matter of time before you see higher consumer price inflation feeding into a number of Asian markets too. You're beginning to see that with some recent data releases. So you're seeing gradually accelerating inflation in India and greater concerns there around rising fuel and energy costs. You're seeing the highest inflation in South Korea in about 10 years, and a clear accelerating trend there, clear accelerations in the Philippines, a surprisingly high kind of upside surprise figure out of China, even though China's inflation has been relatively muted so far. So this is increasingly an issue that every single multinational is going to have to face, and it's complicating pricing decisions due to the concerns our clients are facing around the possibility that the price increases they've been passing on to consumers might no longer be tolerated.
So, Elizabeth, that creates an environment that just creates truly a shift for our clients and really unprecedented challenges for them, since really we've been operating in kind of low and stable inflation environment for many, many years. And so can you talk a little bit about what our clients are doing to kind of manage these sets of challenges?
Yeah. So again, it's been the case for several months now that our clients are seeing rising and rising input costs. And we know our clients are already in the process of reevaluating their supply chains, that they've had to do this for several months now to reconsider where they source their inputs, to reconsider the inputs that they're using, the ingredients they're using in their products, to reconsider the products that they're selling, to focus more on higher margin goods, especially, or goods and services, especially in an environment where certain inputs are seeing faster price increases than others. We're encouraging clients in this environment where we're expecting these pressures to get even stronger to sort of double down on efforts to reconsider their entire supply chain and efforts to re-optimize their supply chains. That, you know, you may think that you're doing a lot already, but to consider ways of getting a bit more aggressive and creative in terms of reevaluating your supply chains in this environment. The second thing that we're encouraging clients to think about, and that we know our clients are thinking about, is how they approach pass-through decisions in an environment where consumers in particular, as well as businesses, are going to be increasingly price sensitive. So if it's been the case in the last several months that clients are passing through most of their input costs increases onto their customers, now they're going to start to see more backlash against that, and the risk that customers and consumers may start to cut back on spending and investment, may start to trade down. And so we actually, we came out recently with an index helping clients to contextualize this risk across the world. And this is kind of what it looks like on a high level. We call this the risk of consumer demand destruction. The consumer is the focus here, given that that is kind of the end of the supply chain in most cases. So this is relevant, obviously, especially for consumer goods firms, but also for B2B firms whose products eventually feed into consumer products as well. This index incorporates, it's a qualitative index, so ranging from very high risk to low risk, but it's sourced by a number of quantitative inputs, including recent inflationary pressures, so how high is inflation in that market right now, our assessment of future inflation risk, especially stemming from the war in Ukraine, so countries that are more integrated with supply chains with Russia, Ukraine, and Belarus, and countries that import a lot of commodities that are seeing extreme price pressures right now are going to be higher risk of future inflation. It also incorporates an assessment of consumer vulnerability. So basically a measure of the share of the consumption basket devoted to spending on food and energy and transportation, which are the areas seeing the highest inflation right now. Where consumers are more vulnerable, we assess them to be more likely to cut back on discretionary spending, to trade down, to shift their consumption to other goods and services. And so putting all those factors together, this is our assessment of the risk of demand destruction. Where you see higher risk is where we anticipate that clients are going to have a harder time passing through their higher input costs onto consumers in the coming months. And those markets tend to be concentrated in Central and Eastern Europe, as well as Sub-Saharan Africa.
Elizabeth, I noticed the US is one of the few markets on this map that's rated low risk according to the index. By the way, I think the index is fascinating. We could probably do a whole episode just on the index, and maybe we should, because I think it's critical in portfolio planning. But anyway, coming back to the US, I find it a little bit surprising because certainly there's a ton of concern in the US amongst market analysts, amongst policymakers, that the inflation acceleration that we're currently seeing will drive down consumer spending. When you look at the actions by the Fed and the likely rapid rate hike path that they're taking, there's a lot of concern that recession is on the horizon. So could you kind of just give us a little more detail on that?
Sure. So actually, if you look closely at the map, you'll see there are only 3 countries in that low risk category: the US, Colombia, and Australia. A few months ago, actually, when we first came out with an earlier edition of this index, there were a handful of other countries in that low risk category, including China and Japan, since they weren't seeing many inflationary pressures yet. Most countries have moved into that medium risk category. The US is kind of on the cusp, but still in the low risk category. And it's got kind of divergent factors affecting it. So it's obviously got high inflation relative to recent history, and that's why you hear a lot of concern, hand-wringing in the US around inflationary pressures, the political implications of high inflation. So the US is in a high inflation environment for sure, but it's insulated from a couple of these other negative factors faced by other markets. First off, it's a bit more insulated from the impacts of the war in Ukraine. It's not as integrated with Russia in terms of trade, Russia or Ukraine in terms of trade and in terms of supply chains. And it has a large extractive sector. It's a relatively autarkic economy by global standards, and so it can rely on its own inputs for a lot of its own production. And so we assess it as it's slightly lower risk of higher inflation compared to most of the rest of the world. It also has richer consumers compared to most of the rest of the world. So in terms of consumer vulnerability, it comes down quite low overall. Now, of course, there are still risks around demand destruction at lower income segments, because lower income consumers in the US are experiencing higher inflation. They're less able to tolerate it, and they spend more of their incomes on food and energy, which are some of these high inflation areas. So low risk does not mean zero risk. And actually, the fact that there's still some risk in the United States is sort of a good case in point for how we expect customers across our client base, clients across our client base to face greater challenges in passing on their costs in the next several months, even in markets like the United States.
Okay, I know I want to move on to topic number 2. I do have one last question though, because with the US print of 8.5% yesterday, some are saying that if you dig deeper, peel the onion back on the number, that there are signs that the inflation in the US, inflation acceleration in the US has actually peaked. I'm just curious, do you share that view?
To a great extent, yes. And our general assessment and outlook for the rest of the year is that consumer price inflation in the US is likely to peak in the middle of the year. Number of reasons to point to. Actually, even nowcasts for inflation in the next couple of months even suggests it may be peaking as soon as May. So that's something we're watching quite closely. Again, it has to do with the fact that the US is relatively less exposed to some of these inflationary pressures stemming from the war, and the fact that a lot of the consumer price inflation in the US has been more demand driven, having to do with some of the pandemic era stimulus and the kind of expansion in purchasing power among consumers in the United States has kind of contributed to some of these inflationary pressures. So I would say overall, we're generally on that same page, but we're a bit cautious because there have been a number of calls over the last year about kind of transitory inflation. And so we're not kind of ignoring the risks of a potential kind of reacceleration in inflation, especially given the uncertainty around the war impacts.
Yeah, and let's remember that wage inflation is sticky. It doesn't go back. All right, let's move on to the next topic. I'm curious to hear your updates on the manufacturing sector. Immediately after Russia's invasion of Ukraine, I know that FrontierView anticipated major disruptions to European supply chains and European production. How is this all playing out, given, especially given the importance of Germany as a manufacturing center globally?
So it's been very interesting to see some of the very early data coming out on this. Most of it coming from surveys of purchasing managers and these global PMI, purchasing managers indices, from March. So basically surveying purchasing managers around the world and getting their early assessment of changes in output, orders, inventories, all of these different measures that we can use to assess the state of global manufacturing. And it's been interesting to see this play out very much along the lines of what we anticipated. So we anticipated even higher input cost inflation, higher selling price inflation, contributing to higher inflation along the supply chain. We're seeing that play out. Actually, immediately prior to the invasion, you saw early signs of some peaking in producer price inflation in certain markets. But in March, we saw a reacceleration in inflation across manufacturing sectors around the world. In terms of variable impacts across markets, it's also playing out largely along the lines of what we expected. And one way to illustrate this is through a matrix that we actually update every month, showing near-term manufacturing trends across some major manufacturers around the world. On the y-axis is the latest manufacturing purchasing managers index. When it's above 50, it indicates the sector is expanding. And then the x-axis is the recent change in the index. So it sort of indicates acceleration or deceleration in terms of activity. And last month, you had a number of markets in Europe well in the top part of the matrix, so indicating expanding manufacturing, and they were also tended to be concentrated in that strong and strengthening part of the matrix. So European manufacturing was on a tear prior to the invasion, and in March already you've seen an immediate deterioration there. So most of those blue dots have kind of shifted into the strong but weakening category. Obviously, no surprise, you've seen a deep manufacturing sector contraction for Russia. You've seen bigger impacts on Central and Eastern European manufacturing. So in Poland and the Czech Republic, you've seen declining output for the first time basically since the early stages of the pandemic. And then in markets like Germany and Spain, you see a slowdown in output. So it's not contracting yet, but you're seeing declining new orders. So this is a fast deterioration for the European manufacturing sector. We also saw some weakness in Asian manufacturing in March. Some of this has to do with Ukraine war spillovers, but there's also the issue of COVID, both in some of these markets that saw some Omicron waves in March. A lot of that has passed or is kind of passing peak in some of these APAC markets. So there may be some improvement there in the coming months, but markets that are well integrated with Chinese supply chains, so especially Japan, for example, you've seen some deterioration there due to China's lockdowns. So these are kind of, again, things are playing out more or less as we expected in terms of which markets are worst impacted. We are seeing a few bright spots. So we kind of made this call early on that markets that have large extractive sectors with manufacturing sectors that feed into the extractive sector are likely to be more resilient. Also markets that are farther away from the conflict. So that includes the US and Canada, Australia, big commodity exporter, as well as Saudi Arabia and Qatar, big oil exporters. And there they are right in the top part of that strong and strengthening part of the matrix. So just very interesting to see this play out more or less as we expected. And overall, we'd say even though this matrix focuses on near-term manufacturing trends, that this is likely to be the theme for at least the next several months.
Okay. And what about inventories? Are you seeing any buildups, any shifts in inventories? I know that a lot of our clients, because of the supply chain disruptions, have stockpiled inventories, especially those in certain sectors where there might be some seasonality to their clients' buying patterns and that sort of thing.
Yeah, that was actually another really interesting theme that came out of the purchasing manager surveys from March is inventory buildup, not in every market, but a general theme across a majority of markets. Two drivers of that, in most markets, you saw manufacturers stockpiling, as you say, trying to get ahead of expected acceleration in inflation for a lot of these inputs, as well as outright shortages. So just buying up inputs as quickly as they possibly can. In some cases, particularly in Europe, where you're seeing slowing new orders and slowing output, this was also unintended inventory buildup. So inputs were bought, and then there's been a slowdown in production, so they're not being kind of offloaded and passed along the supply chain. So that's actually a concern to highlight across the global portfolio, that for markets where we may expect some weakening later on, or further weakening, especially in the case of Europe, that we could see kind of over ordering as an overreaction to the risk of input shortages, and then not enough customer demand to justify that inventory buildup.
Okay, let's go to topic number 3, and I feel like Dr. Doom here, adding to the gloom and doom, but I do want to talk a little bit more about the latest regarding China, and specifically the virus lockdowns and the zero tolerance policy. What's been going on within China from your perspective? What do you see as kind of the specific impacts on global supply chains and all of these other factors that we're talking about?
Yeah, so as you mentioned, China is in the throes of a major COVID-19 wave. We can illustrate it in a few ways, and the kind of clearest one is to simply show the latest case rate. It's the highest it's ever been during the pandemic. Worth noting that the actual level of this case rate is not really that high by global standards. So I'm in the UK, and we have a higher case rate right now than China does. But the UK has kind of left its restrictions, and China is still continues to pursue a zero COVID policy. So as a result, you're seeing lockdowns in China that are concentrated right now in the areas of Shenzhen and Shanghai. Shenzhen is kind of past, at least for now, the strictest restrictions from a couple weeks ago. So it's kind of back up to like 50% activity, whereas Shanghai continues to be in the throes of some very strict lockdowns. The CCP, obviously kind of anticipating the great economic disruption associated with these lockdowns, has been pursuing what they call dynamic lockdowns. So it's not that they lock down all of Shanghai at once. They go neighborhood by neighborhood or section by section of the city, and as soon as cases have fallen to zero in that area, they lift some restrictions. So as a result, overall, our China team estimates that about 10% of China's population is in some form of lockdown right now. That leaves 90% kind of as normal in terms of consumer activity and demand. But the challenge is that 10% are concentrated in China's big economic hubs. So big manufacturing hubs, as well as exporting hubs. What we're seeing right now, in contrast to some of the early fears when we saw Omicron beginning to spread in China, there was a lot of concern about port shutdowns, manufacturing production declines due to worker shortages or shutdowns in manufacturing, in part because that's what a lot of APAC markets have seen throughout the pandemic. And ASEAN, for example, that's been kind of what we've seen so far in terms of supply chain disruption. In China, what we're seeing, actually the biggest disruption is to internal freight and trucking. So even though the CCP has managed to keep ports open, to keep workers operating in manufacturing facilities, in large part through kind of very strict measures to keep workers there, you're still seeing disruptions in logistics throughout China, and they tend to be earlier in the supply chain. So it's not that China's facing challenges exporting, it's that it's facing challenges earlier on in production. And where you face a disruption earlier in the supply chain, all else equal, it tends to be more disruptive because it kind of feeds through to global supply chains from there. And we likely are not seeing kind of all of the effects yet due to those big expected impacts. So far, it seems to be that probably the biggest risks are in the areas of consumer electronics. but it's likely to be widespread across kind of variety of manufacturing supply chains in China. So big concern for the global economy that we're just kind of beginning to process and witness.
Do you, last question, because I know we're up against time, but I'm just curious, do you see an off-ramp for the CCP with regards to this zero COVID policy? Like they've kind of backed themselves into a real corner, which appeared to be the right strategy early in the COVID crisis, but right now it seems like they've lost control. And I guess, is there an exit ramp for them to kind of reverse course on that policy?
So our China team and our general firm stance is that China will be pursuing zero COVID through the end of the year. And this has to do with the fact that the CCP has basically predicated its political reputation on its ability to control the virus. And it's in a politically sensitive year. So we've got the 20th Party Congress coming up at the end of the year, and they cannot kind of sacrifice that reputation. In terms of, obviously, continued pursuit of that strategy entails other risks around economic growth, and so they're concerned about the risk there as well. It's a very delicate situation, and simply abandoning zero COVID, it is not feasible due to that kind of political reputation issue, and also due to issues of hospital capacity in China, which are relatively low compared to most markets. And so as well as due to low vaccination rates in China. So if they simply let the virus kind of take its course, it will have big negative impacts on China. The kind of optimistic off-ramp scenarios that we're thinking through right now are around vaccines. So the possibility that China might approve a Western vaccine, obviously some kind of political barriers to doing that, but it's something they may consider. Or that there kind of there's ongoing research and development in their own mRNA vaccines. So there's a possibility that a new mRNA vaccine could come out of China. Even if in that optimistic scenario, it would take several months to kind of approve the vaccine, to produce enough to produce 1 billion vaccines. So there's no easy solution for China here. And that's what underscores our expectation that this is likely to be a theme throughout the year. Not necessarily that Shanghai is going to be locked down all year, but that you will see kind of rolling shutdowns throughout China. Big thing to kind of factor into the global economy, and that's why our China team right now is hard at work looking at scenarios for China's growth this year.
Yeah, you've double whammy of domestic consumption within China being hit, but also, as you mentioned, the various implications across the inputs to the supply chain and the broader manufacturing sector. So we'll keep a close eye on this. I'm sure we'll talk more about it in the coming episodes, but that's all we have time for today. Elizabeth, thank you. As always, fascinating insights. Can't wait to do this again next month. And for our clients, as a reminder, you can speak with Elizabeth or any of our FrontierView research analysts at any time by just reaching out through your client services manager. That's all we have time for today. Thank you so much, and be sure to join us again next month for more GlobalView insights.